My name is Jeremy Kasdan, Sales and Partnerships Lead at FinTech TV, and Taking Stock starts now.
Two minutes to go here into the closing bell on this Friday, April 17th. Oil prices tumbling, stocks soaring, fresh all-time highs into today's closing auction for the S&P 500, the tech-heavy NASDAQ, and the Russell 2000. Bobby, walk over with me this way. We got some very special guests. Are you all excited to be here at the New York Stock Exchange today? There you have it. Thank you, everyone, for being here. And you brought some fresh all-time highs for the stock market. Thank you, everyone. We got risk up, volatility down. That is, in fact, the tale of today's tape. Discretionary stocks, industrials, and real estate. Those are your strongest performing sectors in the S&P 500 for another history-setting day here on the street. Energy and utilities are your S&P 500 laggards on the day. The Mag 7 technology stocks all higher in a big way. Tesla shares into the close up about 3.5%. Netflix shares have been sharply in focus, down 9% on the day after Chairman Reed Hastings announced yesterday he is set to leave the board of the company that he co-founded all the way back in 1997. Oil benchmarks taking a big leg lower. We'll talk a lot more about the oil and energy stocks, as well as West Texas and Brent crude coming up in just a bit. The crypto majors up in a big way. That and much more on today's edition of Taking Stock. A one for the history books. The great Caleb Silver of Investopedia is on deck. He'll join us right after the bell. The team from Pinnacle West, ticker symbol PNW, set now to do the honors. I love when there's a big enthusiastic crowd. It means I have to do less talking. Your final tail of the tape on this Friday, April 17th. Everyone's hyped up for these all-time highs. The first ever close for the S&P 500 above 7,100. The benchmark index up 1.2% on this Friday. The Dow 30 up, looks like 1.8. The New York Stock Exchange Composite Index up a cool percent. And the small caps up 2% for a new round of fresh all-time highs. Caleb Silver, editor-in-chief at Investopedia, kicks us off. Now, the last time you and I spoke in this interview, you said, are you not entertained? Fresh all-time highs, 7,000 in the S&P and pushing up more broadly. What are you seeing across these markets? What a week, Caleb.
Yeah, well, somebody cue Sly and the Family Stone, because you got to take me higher. All-time highs across the board. See everything rally. Pretty much, you name some of the sectors that were rallying. Sectors like transports, sectors like financials, sectors like semis, everything rallying today off of that good news, semi-good news out of the Gulf, and we'll see if it lasts, but right now the enthusiasm is strong, and these record highs usually beget more record highs.
Yeah, we still have war, we still have geopolitics. These things are top of mind. Caleb, what might shake investor confidence in this market?
Well, we've been surveying our readers as we always do, and they say the war in Iran, geopolitical uncertainty, higher oil prices, higher inflation. Right now, we look like we have a reprieve. We may be overbought. We were oversold. That's just our animal spirits taking over. Individual investors have hung in there, most cautiously optimistic. That said, some of them still worrying that the worst may be yet to come, even though we have this great green news in front of us today.
For the most part, are we still seeing those day-to-day retail investors rotate and put a focus on those same names, the Apples, the Nvidias, the Microsofts? Any interest this week, by the way, in the new Allbirds AI stock, I wonder? What a story that was.
Yeah, what a story that was. You and I should just change our company names to AI as well, but not chasing meme stocks, chasing the home cooking, chasing the favorites, chasing the favorite stocks that got them here, and we've been watching what they've been buying over the last 4 to 6 weeks. It's the huge names. It's Apple, it's Microsoft, it's Amazon, it's a lot of the chip makers, of course. On the sell side, though, they were right. They've been selling Netflix, they've been selling some of the oil stocks as they've gotten high going into this ceasefire.
Yeah, I mean, isn't it incredible how quickly the sentiment has changed? That last big University of Michigan sentiment survey, the lowest they've ever seen. Granted, that was before the ceasefire. That was the narrative so strongly. And here you are, fresh all-time highs. What do you make of seemingly how quickly consumer and retail investor sentiment has shifted in a couple sessions?
That's our animal spirits talking. Consumers feel terrible. I don't think they feel much better today, even with stocks at all-time highs. Investors, though, are focused on other things. What are they focused on? Profit growth. Profit growth is going to be some 12.5% this quarter, year over year. 6 consecutive quarters of profit growth. If big tech, the home favorites from these individual investors, put up the numbers and back it up with good guidance, I expect the market to go higher. This is a real relief rally, but it's been lasting now for what, 14 sessions?
Yeah, would investors do anything different with an extra $10,000 right now, or are they more likely to continue to buy in a lot of these same names?
Individual stocks, and you know that is a great measure of discretionary spending and sentiment. If they had an extra 10 grand, we asked them, what would you do with it? They would buy individual stocks. What stocks would they buy? The same ones they hold today. And then we ask them, JD, what stocks would you buy and hold for the next 10 years? Same group of stocks. We're unwilling to change our preferences. Hard to change preferences when the returns are what they are.
My man, before I let you go, what do we see in terms of data today, intraday? How many 52-week highs?
Yeah, I was looking at 52-week stocks today. 360 stocks at 52-week highs, like 30 at all-time lows. You've never heard of any of them. 165 stocks at all-time highs today. Stocks like Caterpillar, Dana, FedEx, Ross Stores, West Coast shout out to Charlie Munger, chip stocks, retailers, cruise stocks, you name it, all green all the time.
That was Ross, as in Ross Dress for Less.
That's right.
Absolutely, for our California friends, certainly know Ross Stores. Caleb Silver, editor-in-chief at Investopedia. I should start calling you Caleb Silver AI. I think you and I just need to add AI to the end of our names and see what happens.
I agree.
My man, thank you for being here to kick off our Friday broadcast. All-time highs. Come back anytime. Enjoy your weekend.
Thank you.
Skylar, take your mic. Bobby, you and I will head this way. I'm going to wait for the crowd. Yeah, I'll wait for them to pass. All right, we'll bring you a few Bank of America analyst calls that move the tape today here on Wall Street. First up, B of A adding JP Morgan. I love when one bank gives an analyst call on another bank. They're adding JP Morgan to its list of US 1 stocks of top ideas, and in doing so, removing Goldman Sachs from that list. Though Goldman does still have a buy rating. Thank you, Bobby. Next up, B of A reiterating Netflix as a buy despite the Reed Hastings news. A brutal tape today, but still in positive territory year to date. Finally, B of A reiterating Apple as a buy, calling it the highest quality name supported by services growth. Shares of AAPL about flat since the start of 2026. Bobby, let's take a look at two notables that call the New York Stock Exchange their home. First up, UNH. Once upon a time, this was the big dog in the Dow. Not so much the last couple of years, but shares having a nice take today, up about 2.5%. Morgan Stanley naming the healthcare giant a top pick ahead of earnings, expecting what they call a string of clean quarters, up today, but still down about 2% year to date. And let's take a look here at Alaska Air Group. How about the major airlines catching a bid as we saw oil plummet on the day? ALK up more than 10%, the best performing airline in that sector. Still down for the year. The average one-year price target for Alaska Air Group sits at about $57.50 a share. That's upside potential of about 23% off of these current levels. Actor and Bitcoin skeptic Ben McKenzie is out with his brand new documentary. It is called Everyone is Lying to You for Money. Here and now is a look at my recent sit-down, part 2 of my recent sit-down with Ben McKenzie, which we recorded here last week at the New York Stock Exchange. Ben McKenzie joins me now right here overlooking the trading floor of the New York Stock Exchange. He is the writer, director, and co-producer of the brand new film, Everybody is Lying to You for Money. He's also the co-author of the book, Easy Money. Really nice to have you. Congrats. Thanks for joining us.
Thanks for having me.
So let me ask you about the Sam Bankman-Fried interview, July 2022.
Yep.
He's arrested 5 months later, December of that year. 7 counts of fraud and conspiracy. You lay them out in the film. When you think back to that interview, hope you don't mind me saying, it's awkward to watch.
Yeah.
And spoiler alert to our audience, you got this guy and you got Sam Bankman-Fried. I'll let you decide which one is the more awkward of the two. What do you remember? What felt off in that interaction with him?
Everything. Really? Everything. Yeah, I mean, it started bizarrely in that he only had one handler with him, and he's supposedly one of the 100 wealthiest people in the world. Now, I have not spent a ton of time around billionaires, but I've been in showbiz and I've been around powerful people, and they usually have more than just, it was one young woman. And I had rented this conference room in a Midtown hotel because he was in town. And she introduces herself, a young Asian woman, and she says, "Oh my God, I'm a big fan of the OC." And I said, "Oh, well, fantastic." And the room was very small. We had 2 cameras. And I also had my co-author of the book, Jacob Silverman, in there. And so there really wasn't a lot of room. But I also didn't want the publicist / handler in the room with me, as I was conducting this interview. So I said, would you mind, thank you so much for being an OC fan, would you mind just waiting outside? And sure enough, she did. And so I had an hour with him, a little more. And yeah, and it was just the most bizarre hour of my life. I mean, I can't even, I'm still trying to process it because, you know, you have to understand that at the time, Sam Bankman-Fried really was on top of the world. You know, he was on the cover of Fortune magazine. Actually, the guy that was interviewing him before I went in there was writing an article that would become this profile of Sam on the cover of Fortune with the headline, "The Next Warren Buffett?" ? So he really was everywhere. He just hosted a conference in the Bahamas with Tony Blair and Bill Clinton. He was on Capitol Hill trying to persuade lawmakers to do favorable legislation for the industry. And he was touted as this boy genius, you know, this 30-year-old kid from MIT and Jane Street that was revolutionizing the world of finance. And yet if you looked at it, and I go into this more detail in the book, there were so many red flags for fraud. I mean, he's running an exchange out of the Bahamas. He's selling these things that are called currencies, but most of them are really operating more like securities, right? Unregistered, unlicensed securities, in my opinion. And he also has a trading company and an exchange, and they're in the same building, and his trading company is run by his supposed ex-girlfriend. I mean, what are we talking about here, right?
Here, I looked this up last night, though. When you did that interview in July 2022, that's how my brain works, covering markets. Bitcoin was trading at the time of around 23,000.
Right. Yeah.
Obviously, we've had this big rise and this big drop.
Yeah.
Since you did that interview, it's up more than 200%. And I think therein kind of lies the rub.
Yeah.
For a lot of people who have done quite well with it. Gerard Butler, your exchange with Gerard Butler
Yes.
is really funny in the film.
Yeah.
But he is essentially one of these guys who's like, I got to be honest with you, dude. I've crushed it, bro.
Right.
I'm doing great
Right.
with this stuff.
Right.
How do you kind of marry in that lived experience for so many people versus what you really believe in and your concerns?
Yeah, absolutely. I mean, look, you know, the best argument, probably the best argument that Bitcoin has is if you bought it early, you would have made money. But if I'm describing it and others as a Ponzi scheme or a multi-level marketing scheme, and you're saying if you got in early, you would have made money, well, that's one of the features of a Ponzi scheme or a multi-level marketing scheme. So it doesn't actually address the underlying critique. It's effective psychologically, because who doesn't want to be rich? But it doesn't address the critique. You know, what's happened in the interim is, quite frankly, crypto's gotten into our regulated system in a variety of ways, originally via ETFs. Gary Gensler approved those under the Biden administration. But then really, of course, I mean, we have to acknowledge the elephant in the room. It's Donald Trump. Donald Trump's embrace of crypto during his re-election campaign in 2024 has just inflated the market, or had inflated the market to a remarkable degree. And that's really kind of interesting to look at, because as recently as 2021, Donald Trump called Bitcoin a scam. But now that he's made billions of dollars via various crypto schemes, he seems to like crypto quite a lot. And as the President of the United States, he can do a lot to affect the future of crypto via loosening, you know, taking apart the SEC, influencing lawmakers to pass legislation that's favorable to crypto, which they've already done last year, and they're threatening to do again. But that in itself was an irony, right? A deep irony. I mean, crypto was supposed to be the decentralized, democratized future of finance that was outside of government control. And yet now, it needs the most powerful person in not just our government, but any government in the world in order to guarantee its future success.
Welcome back to the show. Ahead of the highly anticipated, at least in my household, NBA playoffs, let's now bring in Rick Horrow. He is sports business analyst at FinTech TV. We're here to talk all things the National Basketball Association. Happy Friday to you here, Rick. First off, how are ratings looking for fans watching the NBA from the comfort of their own couch as we head into the playoffs this weekend?
Up 8-9%, and even more. Look, the play-in tournament is a newfound way to get more teams interested. If you're 8, 9, 10 seed, I know I'm Miami 10 seed ousted, but man, it was an interesting couple of weeks to get here. About a 25 to 100% premium ad rates for any playoff game. These are playoff games, and even if they're probably not going to win the NBA championship, You can't tell the people in that city that it's going to happen. So it's like your household, right? You're excited about the playoffs. Let's assume they started 2 days ago.
Well, right. Yeah, that's fair. So I feel like the early the chatter, the perception of the play-in tournament has been maybe surprisingly popular. We all just saw what Steph Curry did a few nights ago. How has it been received, and has there been any criticism of the new model?
Well, the new model is always tinkerable, just like the playoffs in NASCAR and the FedEx Cup. I'm here to golf tournament. Everybody wants to tinker with it. But at the end of the day, tinkering just means you want to get it better, not to eliminate it. And yeah, we saw what Steph Curry did. On the other hand, Miami and Charlotte was a hell of a game as well. And all of these games are interesting because by definition, these teams are pretty close. And there is some drama to a one and done. As we know in baseball, they've adopted that system as well. And so, like I said, it's another opportunity to generate more real estate for TV. And let's remember, the TV deal is a $76 billion deal. Amazon is covering the play-in tournament for the first time. A streaming service gets it from beginning to end. More to come.
Yeah, and that probably leads us to the conversation about franchise valuation. These are some eye-popping numbers here, Rick. Obviously, the Golden State Warriors, the New York Knicks, the LA Lakers, they're the top dogs in the league. But the average NBA team is now worth more than $4.5 billion. What is driving these valuations higher and higher every season?
Yeah, some would say you're wrong. Yeah, the average is about $5.5 billion. And yeah, you think Golden State is eye-popping at $11.33 billion? I would say so. What's driving it is the arenas that are being built, the international expansion of the game from a branding perspective / getting ready for the Olympics, the $76 billion TV contract, and the lower relative get-in price. I know $4 billion is not low, but that's the value of Memphis. And if you want to do it, you can probably do it easily. Baseball was the low get-in, not today. Jose Feliciano, the other one, just put in a bid for the Padres for $3.9 billion on the baseball side. So low get-in still works in basketball.
Yeah, I think the valuations are so high, at least here in New York, because it would cost me about $500 if I wanted to go to the Knicks-Hawks game tomorrow night at the world's most famous arena. The thing is, as the more expensive those playoff tickets get, the more and more comfortable my couch looks. Rick, before we let you go, who do you got winning it all this year?
Oh, wow, interesting. I'm thinking Oklahoma City. You know, I was involved in that deal. I'm excited about it. Here's the other winner, the NBA. Vegas, Seattle, going for nearly $10 billion at the end of that bidding process. And if you think values are high now, my friend, they're even higher longer term. Take out a mortgage, suck it up, go to the Garden, root for the Knicks.
Yeah, OKC also the odds-on favorite among poly market participants as well. All right, Rick Horrow, sports business analyst at FinTech TV. Enjoy the playoffs. Enjoy the games. Go Knicks. Rick, thank you. Don't go anywhere, folks. A lot more Taking Stock coming up live from the big board right after this. Welcome back. Excuse me. Remy Blair sat down with Ali Wallace of Morgan Stanley to talk all about their brand new Bitcoin ETF. Take a look.
Welcome to FinTech TV. The cryptocurrency market is seeing a surge of institutional interest this April, and leading the charge is Wall Street's first bank-issued spot Bitcoin ETF, and it is trading under ticker symbol MSBT right here on NYSE Arca. Now, the fund was launched last week with a highly competitive 0.14% fee, and the launch by Morgan Stanley is adding fresh institutional attention to the market. Well, joining me at the New York Stock Exchange to discuss this historic launch is Ali Wallace, Global Head of ETF Strategy at Morgan Stanley Investment Management. Well, Ali, welcome. Thank you so much for joining us today.
Thank you for having us.
Well, I do want to ask you about MSBT. So give us an idea of the demand you're seeing so far.
Right. So, we launched the product because we were seeing client demand just from the overall on our platform. So really are trying to boil it down to three areas of the market from a client perspective. What we're seeing right now is really from the direct investors. So that's been a lot coming through our E-Trade platform. But really the other two segments that we're focusing on that is just getting off the ground is that intermediary channel. So everything from the high net worth client, independent advisor, wirehouse, and then lastly the institutional investor, which has been, is taking a longer time to actually acclimate to the market, but really has interest and understands that this is a long-term position that they need to look at. So that's really the three areas of the market that we're trying to focus on.
Yes, and Ali, it is 2026. We just kicked off the second quarter, but we know when it comes to digital assets, in particular the crypto majors, there is a lot of institutional demand. So tell us what's behind some of this demand in terms of the areas where you are getting a lot of questions.
Yes, I'd say that a lot of investors want to understand the benefit, the correlations, how is this going to complement overall portfolio. Even within Morgan Stanley, we have investment teams that already use the cryptocurrency ETFs. So that it was started as a home effort, as actually having interest in this. So the institutional investor, I think, is starting to understand that as if they're going to get exposure to this long-term play, they need to address and understand how they place this in their portfolios.
And I do want to hone in on the structural advantages of MSBT here. So how are you positioning some of these advantages to capture the institutional assets?
Sure. So, as you mentioned in the beginning, so we are the cheapest in the market for a Bitcoin ETF as of right now, so 14 basis points. So price is one thing, and we are able to do that due to our scale. But I'd say that some other levers that we tried to pull were who we worked with from a partner perspective. So this is the first Bitcoin ETF that actually works with a dual digital custody model, of one being a native digital custody and the other being a GSIB bank. So really tried to bring together these two partners to create a more aforementioned product.
Yeah, and building on what you just said, Ali, we spoke to the president of CoinDesk earlier this week. So tell me a little bit about the custodial model here.
Right. So in that, we have this dual custodial model that this is very much trying to ensure that from a protection standpoint, which, I'd say some investors are always, hesitant from who their digital custodians are. So we thought of pairing a native digital custodian that has a lot of that infrastructure background, understands the market, as well as pairing it with more of a GSIB traditional custodial bank, that would bring more, I'd say, ease to the market from investors that are not as used to being in that digital native environment. So we really wanted to ensure that we were bringing both of those mindsets into one product, and so that's been an exciting aspect to launching this.
Well, Ali, great to have you on the show. Thank you so much for joining me here today at the New York Stock Exchange.
Thank you so much for having me.
I'm Scarlett Sieber, and this is Hindsight 2020, the show where history reminds us that if the most important financial shifts don't always arrive with headlines, sometimes they slip in quietly and redefine everything. Let's rewind more than 50 years. It's the early 1970s. Think about that for a second. Gas is about 36 cents a gallon. Suburbs are expanding, the post-war economic engine is still humming, and most people believe, without really questioning it, that money is stable because it's real. The dollar is still tied to gold, or at least that's what everyone thinks. On April 19th, 1971, the United States was facing a monetary problem that could no longer be ignored. Foreign governments were increasingly demanding gold in exchange for their dollars. America's gold reserves were draining, and the math behind the global currency system was starting to break. This wasn't a press conference moment yet. There were no announcement, no market shock, no ticker tape panic. But inside the government, the conclusion was already forming. The rules that had governed money since World War II, they were no longer sustainable. So what was actually happening? Under the Bretton Woods system, global currencies were pegged to the US dollar, and the US dollar was pegged to gold. As long as confidence held, the system worked. But by 1971, US deficits, Vietnam War spending, and growing trade imbalances meant there were simply too many dollars chasing too little gold. The promise had to become impossible to keep. Why does April 19th matter? Because this is the moment when fiat money stopped being theoretical risk and became inevitability. The US could either continue bleeding gold reserves or abandon the peg. A few months later, President Nixon would formally take the dollar off gold. But April 1971 is when policymakers understood there was no path back to the old system. That single shift rewired global finance. Once money was no longer anchored to something physical, central banks gained extraordinary flexibility. Governments could run deficits longer, liquidity could expand faster, asset prices could rise alongside credit. Let's fast forward to 2026. You're living alongside and inside the consequences of that decision. Trillions in sovereign debt, central bank balance sheets measured in the trillions, inflation debates that return every cycle, and the rise of alternatives from digital assets to private currencies driven by a lingering discomfort with what money actually represents. Every modern argument about monetary trust, inflation protection, and financial credibility traces directly back to this quiet unraveling in 1971. There was no crash that day, no bank run, no panic at the pump, just a slow realization that money had shifted from something you could hold to something you had to believe in. The real mode of the US dollar stopped being gold. It became institutional trust, economic gravity, and global coordination. And maintaining that trust has been the defining challenge ever since. That, my friends, is your Hindsight 2020, because once money loses its physical anchor, confidence becomes the most valuable asset in that system. If there's another moment in history you want to rewind, drop it in the comments. Hindsight always has more receipts. In the meantime, back over to you.
Go. All-time highs. Thanks for watching. We'll see you again next week.